So take a look at this chart. It shows the annual change in core CPI, so in the core consumer price index, that's the blue line. This green line on here is the effective Fed funds rate. And here's what I want to call out attention to. I took this chart back to 1990. These shaded areas show recessions. When you have the Fed holding monetary policy and the Fed funds rate in restrictive territory, so when you see Fed funds well above the rate of inflation, it has taken a recession to get a meaningful reduction in the Fed funds rate, to bring Fed funds back below where CPI is at. So look back here in 1990, you get a recession, a sharp drop in the Fed funds rate, restrictive throughout the 90s until we get the recession in the early 2000s. That led the Fed to slash rates again below core inflation. Here we are heading to '08. Again, you need the recession before we see a meaningful reduction in the Fed funds rate. Same thing heading into the pandemic. You got a Fed funds effective rate for just a brief period above core inflation. The pandemic hit, we see rates drop. Now we're in restrictive territory again, and we've had this cut, a handful of cuts last year, but it may take something, some more serious risks on the economic front to really see Fed funds move back toward or even get below where core CPI is. And that, again, is just based on the historical precedent of what it takes to see the Fed really move monetary policy.